technically, the markets are looking really bullish here in the short term. But fundamentally, if you look at the macro data, it looks pretty terrible and getting worse, right? There's a real disconnect between how the markets are behaving right now and just what the macro data is telling us. So I want to dig into all that with you here. If we can, as a jump.
It's important too, because we've never had such a disconnect between the actual realities of the economics and how the market is now performing on the surface. And so if you're a money manager, you're pulling your hair out because all your old rules are not making any sense. And of course, you've got to perform, or you're going to lose, you're going to have redemptions. So it's a catch-22. And usually that's the beginnings of the end, because you're forced in. And as you're forced in, suddenly the rug is pulled out historically. The question here is just, how long do we go before the rug's pulled out, and what will trigger the pulling out of the rug? And to answer that, you have to understand why it's realistically going up.
All right, great. And you are someone who has seen a lot of market cycles, so you've sort of seen this play out of a disconnect between markets and reality. And I'm putting words in your mouth, so correct me if these are wrong, but ultimately you generally see that reality wins out in the end, but there tends to be a progression, and you have to understand that progression, because if you plan for reality at the beginning, you very well may get your face ripped off along the way while the market remains irrational longer than most can imagine.
You can be assured of that. And that's what's going on right now, that irrationality. That doesn't mean that it won't sustain itself. And could go much longer than anybody even believe. It always goes longer than you can believe. So the question is, do you stay out of it? Do you go early on the short? But can you stay liquid long enough? And those are the big questions. Frankly, we're investors first and foremost, Adam. So we don't chase the last 5% at the top or the bottom. We wait until it happens. We'll give that up, call it investment, and then we catch the trend. And this trend is still up. This trend is still up. There's nothing that says this trend has begun to reverse. If anything, it's strengthening, but it will reverse. And then when it starts to accelerate to the downside, that's when we get in. So we don't play this. We don't play this game. The key again is to know what would trigger the reversal. Okay, what are the key factors you have to look at to kind of understand what will cause a reversal? Again, it goes back to what's driving it up right now.
Okay, and that is the great question to start with. So I want to let folks know we are going to get in the discussion here to, okay, what to do about this as an investor, and we'll talk about specific strategies. I'll ask Gordon how he's positioning right now. But Gordon, let's look at the potential triggers that could puncture the euphoria and begin to bring reality back into the situation. And in my intro, I mentioned a big potential one, which is debt. And so I'd love to get your thoughts on this, because you just recently issued a great report about the coming conflict over the debt ceiling. But just in general, as I mentioned, there's now over 31 trillion in just federal debt that's out there. The sharp rise in interest rates has really spiked the debt service fees that the government has to pay, basically, before it can then fund the rest of the government budget, right? And there are charts out there that are showing, the interest payments that the government is making really beginning to spike now in response to the hike in interest rates. How bad do the latest numbers on debt service look? I mean, how concerning an issue is this?
In terms of debt here, in 12 months, or maybe a little longer if I want to go back to the America Rescue Plan, but somewhere between $6 and $7.5 trillion. We just put through an omnibus bill for what, 1.7. We bet the Inflation Reduction Act was, I don't know, 740 billion. The CHIPS, 280 billion. Infrastructure bill, 1.2 trillion. That rescue plan was somewhere between 1.9 and 3.5. I can just keep on going. What we're spending on Ukraine, we have never put this much money into an economy than ever before. And so we pushed up the debt ceiling. We're effectively going through that debt ceiling in a big way, because a lot of that money we haven't yet.
I was going to say we actually can't fully fund all that yet because the debt ceiling has to be raised to enable that, right?
Exactly the point. We've authorized it. Big chunks of it are being spent because that's why we're right at the debt ceiling right now, and has forced Janet Yellen to implement extraordinary actions. And so you know, this is going to be as big a fight for this debt ceiling as we've ever seen, potentially. Though there's a little bit of gamesmanship that's really going on, because we've just had a significant change in the Congress. We have a Republican, and I don't know if you witnessed the election of the Speaker of the House. Went with 14, 15 rounds, and then eventually just saw, I don't mean to get political, but we saw the Freedom Caucus a group take over it with some very, very strong hard money fiscal budget restraints to be put in place. So it'll be a protracted kind of period that we're going to go through to come up with a resolution of what that's going to be. You can be assured they will increase the debt ceiling, and the goal here will come in that they're going to agree to some budget, pull in the spending, probably extend the debt ceiling for 2 years. Maybe they concede 4 to 5, 6% of this year's spending of all of that money. So we shouldn't be worried about that. What we should be worried about, thinking about, is the game that's going on behind the scene. And that one of the reasons I put that particular report out that you're mentioning, Adam, is there's always more going on in the government than anybody's aware. And so what's happening here is Janet Yellen in the Treasury, and she's been playing a lot of games here to help Powell. Remember, she was the former chairman of the Federal Reserve herself. They both know each other's jobs and roles and how things really work very, very well. So what Yellen has been trying to do is buy time for the inflation rate to come down to something that's manageable, to allow Powell to increase the rates up until we get to about a 5% terminal rate, thereabouts. With the 25 now, we're very close, getting close to that. But just push it out so that inflation comes down. And she had to buy time, and she's done a good job. But now, how do we buy some more time here? What we have to understand is, with the debt ceiling, she can't issue any more debt. She can issue some short-term bills, but she can't issue notes and bonds. So what that does is, because they're spending down what they call the TGA, and I don't mean to get technical, but it's important for you to understand what's going on in the market and why it's going up, and therefore why it'll come down. So they're pushing money out through the TGA, general account, of spending, but they're not financing it. They're spending it down. That's still keeping liquidity going into the economy, but they're not issuing any notes or bonds. And what that's doing is driving up the price of the bonds because there's a shortage of them. Look at the recent auctions. It pushes down the interest rate. So it's been holding down rates at the same time we've had this problem. And that's what's dramatically loosening, as mentioned earlier, the financial conditions index. And so as that financial conditions index come down, it's a license to chase the market. And that's what's going on. And it's overextended it quite significant. And it could be protracted out here because, as you well know, for the last 2 or 3 years, the market has just mapped perfectly the expansion of the Fed's balance sheet. And what this is doing, it's actually almost dollar for dollar offsetting the reduction in the quantitative tightening that's going on every month as we've been reducing it. And so they've got it set so it's a balancing act. So it's a license to print money right now, effectively, and get into the market. I didn't mean to be long-winded, but that's a bit of it. It's going to end, though. Okay, they're buying time, hoping that inflation, which is coming down, gets down low enough that they can then stop the rates, and we'll get a soft landing. And everything would look like there's a possibility of getting a soft landing. My opinion, not going to happen. A soft landing, that is, it's going to be a brutally hard landing, but it's going to be later than everybody currently thinks. And we'll go into a very major deflationary push as it comes in. The other thing that's holding it up is, I've written extensively about stagflation, where you get high inflation, you get low growth, but you also need a third thing, and it's called unemployment. And we haven't been seeing the layoffs, bankruptcies, et cetera, that the media plays on, and they haven't been playing on that. And so when we start to see the unemployment numbers really showing is when it'll start to, the market will start to really fall.